Introduction to Finance Law: Navigating the Legal Aspects of Modern Finance. Why is finance law important? Transparency in financial markets. Finance law promotes transparency in financial markets by requiring companies to disclose financial information to the public and regulators, ensuring that investors have access to accurate and reliable information to make informed investment decisions. Investor protection. Finance law protects investors by requiring companies and financial professionals to follow certain regulations and standards of conduct, preventing fraud and ensuring that investors are treated fairly. Stability in financial markets. Finance law promotes stability in financial markets by setting rules and regulations that prevent financial crises and stabilize the economy during times of economic stress. Overview of finance law. Securities law. Securities law regulates financial instruments such as stocks and bonds and their sale to the public. Key legal concepts include disclosure requirements, the registration of securities, and the liability of issues and underwriters. Corporate finance law. Corporate finance law governs the financing and operation of corporations. Key legal concepts include the issuance of stocks and bonds, mergers and acquisitions, and the fiduciary duties of corporate officers and directors. International finance law. International finance law regulates cross-border financial transactions, including international trade, foreign investment, and foreign exchange. Key legal concepts include sovereign debt, currency exchange rates, and the regulation of international financial institutions. What is finance law? Securities law. Securities laws are a part of finance law that regulates the issuance and trading of securities, such as stocks, bonds, and options. These laws aim to protect investors from fraudulent activities and ensure market fairness and transparency. Banking laws are a part of finance law that regulates the operations of banks and other financial institutions. These laws aim to ensure the safety and soundness of the banking system, protect depositors, and promote efficient banking services. Insurance laws. Insurance laws are a part of finance law that govern the operations of insurance companies and the sale of insurance products. These laws aim to protect policyholders from unfair practices, ensure the soundness of the insurance industry, and promote affordable insurance products. Corporate finance law. Corporate finance operations. Corporate finance deals with the financial operations of corporations, including funding, capital structure, and mergers and acquisitions. It is a crucial function that enables companies to achieve their strategic goals and objectives. Funding. Funding is the process of raising capital to finance a company's operations, growth, and investments. Corporate finance laws govern the various methods of funding, including equity and debt financing, and protects the interests of investors and the company. Capital structure. Capital structure refers to the way a company finances its operations, growth, and investment through the mix of equity and debt financing. Corporate finance law governs the optimal capital structure and the balance between risk and return. Mergers and acquisitions. Mergers and acquisitions involve the consolidation of two or more companies to create a larger entity or the acquisition of one company by another. Corporate finance law governs the legal and financial aspects of M&A transactions, including due diligence, valuation, negotiation, and structuring. The role of finance in corporations, capital raising. One of the primary roles of finance in corporations is to raise capital to fund business operations and expansions. This can be done through equity or debt financing. Risk management. Finance helps corporations manage risk by providing tools and strategies to mitigate financial risks, such as foreign exchange risk, interest rate risk, and credit risk. Strategic decision making. Finance plays a critical role in helping corporations make strategic decisions, such as mergers and acquisitions, capital investments, and dividend policies. Securities law. Securities. Securities refer to financial instruments that are traded on the stock market, such as stocks, bonds, and derivatives. Securities law regulates the issuance and trading of these instruments. Types of securities. There are different types of securities, including stocks, bonds, and derivatives. Each of the security has its own characteristics and legal requirements for issuance and trading. Legal requirements. Securities law imposes legal requirements for the issuance and trading of securities. These requirements include registration, disclosure, and anti-fraud provisions, among others. International finance law. The Foreign Corrupt Practices Act, FCPA, is a U.S. law that prohibits bribery of foreign officials by U.S. companies and aims to promote fair business practices in international finance transactions. International finance transactions, foreign exchange risk. Foreign exchange risk refers to the potential losses that can occur due to fluctuations in exchange rates when engaging in international financial transactions. Currency controls. Currency controls refer to legal restrictions imposed by governments on the movement of capital across borders. They can affect the ability to engage in international financial transactions and impact business operations. Cross-border taxation. Cross-border taxation refers to the tax laws and regulations that apply to international financial transactions. It can be complex and can impact the profitability of businesses engaged in international trade. Foreign Corrupt Practices Act, FCPA. The FCPA is a U.S. law that prohibits U.S. companies and their subsidiaries from bribing foreign officials to obtain or retain business. The FCPA also requires companies to maintain accurate books and records and to implement internal controls to prevent bribery. Key provisions of the FCPA. The FCPA has two main provisions, the anti-bribery provision and the accounting provision. The anti-bribery provision prohibits bribes to foreign officials, while the accounting provision requires companies to maintain accurate books and records and to implement internal controls to prevent bribery. Impact on international finance. The FCPA has had a significant impact on how U.S. companies do business abroad. The law has prompted many U.S. companies to implement stronger anti-corruption compliance programs, and it has led to increased cooperation between the U.S. and foreign law enforcement agencies in investigating and prosecuting bribery cases. Conclusion. Finance law plays a critical role in ensuring transparency, accountability, and stability in financial markets. It helps drive economic growth and prosperity by providing a framework for fair and efficient financial transactions. Thank you.